Welcome to another episode of Founders Club. Today I'm going to be talking to Ken McElroy, the founder of real estate investment firm MC Companies. He's also the best-selling author of books like The ABCs of Real Estate, and he's a professional real estate investor with over $2 billion in real estate under management. This is going to be a really awesome interview. We're going to be diving deep on tips for doing deals in any market, how he analyzes and finds the best real estate markets to invest in, and the number one thing he looks for when investing in real estate deals. This is going to be an info-packed interview, so make sure if you have any questions, you put them in the box down below. As always, judo chop that like button so other people just like you can find this video. And we're going to be doing some weekly coaching calls live with top producers every single week and industry experts. Make sure you find the link in the description to join those. They're every Tuesday at 10 a.m. Pacific time. We also have a free Facebook group that you can join that has all the information, links in the description. And as always, if you like money and you like real estate, make sure you hit that subscribe button because this is the show for you. We'll see you on the inside. Welcome to Founders Club, the show for real estate entrepreneurs. All right, very excited to be here with Ken McElroy. Been a long time fan from afar, watching the deals you've done, the empire you've built, from the Robert Kiyosaki days and beyond. But really appreciate you coming on today and having a conversation with us.
Yeah, for sure. Happy to educate. I love the business, so let's spread the knowledge.
Absolutely. Couldn't agree more. Why don't we just start with a quick background on like how you got in the game of real estate?
Well, for me, it was super easy. It wasn't strategic at all. I literally was a starving student running up student debt, like so many others. And I got an opportunity to manage an apartment building in the Seattle area, which is where I'm from. It was only 60 units, but the rent was free, so I was like, those are good terms. And I didn't have any clue what I was getting involved in. And I ended up really enjoying the business. But after about a pretty short time, in under a year, I was like, man, I need to be on the other side of the desk where the owner is. And that's when I got my real estate license. I started buying, small deals. And then, 22 years later, my partner and I, we bought a little over 3 billion. We own 2 billion now, all apartments, some office, some self-storage. But I started with my own money and a 2-bedroom, 2-bath that cash flowed. So that's by the time I met Kiyosaki, I was already rolling, and I was actually just pitching him on one of my deals. That's how I met him. I was just raising capital at the time. So I didn't know how to do any of this. Then that's the interesting thing, is all barriers, mindset. I had to punch through myself. My parents were awesome. My mom was a hairdresser. My dad was in construction. I didn't grow up around money, so it was all completely organic and just trying to be in the right room.
Yeah, that's interesting. That's a theme that comes up a lot on the show is being in the right room with the right people and how that can kind of accelerate your career path.
It's worked for me. I didn't really have any other choice. My buddy always told me, he was a musician. He said, if you're the best musician in the band, it's time to find a new band. And so I've just always followed that philosophy where I always just wanted to be around people that knew more, and I just, they became, without even knowing it, my mentors at the time. That's all I did. I literally learned most of what I'm doing today that way. Obviously I'm massively into personal development and all that. I've written all the books and those kinds of things. And I read a lot and I listen a lot, and I listen to, guys like you that are, that are educating people a lot. So that's what I do. But it's just a process.
Yeah, couldn't agree more. And really that room is what's going to be your shortcut to success, right? It's not it's not a get rich quick, but it will help you with the go this way, not this way, try this, not that type of advice that can really kind of push you fast.
Yeah, and so there's really no steps to learning everything there is about real estate, and I still believe I have a lot to learn. But I started with single family, and I think that's a great entry point for most people. And I started in property management. Those two things kind of gave me my base, and from there, I wanted to learn multi-units, and I wanted to learn office, I wanted to learn self-storage. They're very different. I wanted to learn land development. I wanted to learn tax credits, and state and federal. And so everything, I just had to find those people that were experts in those areas and try to be around them and learn and even in some cases partner with them. And then you learn from them. And so that's how my whole career has, developed and moved forward.
Yeah, love that. So you started with a single family home. Now you have billions of dollars under management. Talk to me about that first deal, and then I want to go into the bigger stuff in a little bit.
Well, the first deal was actually a condo. It was a 2-bedroom, 2-bath condo. And I think I cash flowed, just over 100 a month. And I used my
Okay.
own money. I used my own down payment. And then I actually did that a couple times, and it was great. And I was realizing the power of passive income. And this was way before I met Robert or anything, but I realized that, hey, if I just accumulate 10 of these, I'm going to, be in a situation where I'm going to have enough passive income then, to cover my expenses. And that was really my initial mindset, was try to just cover my monthly expenses at the time. And then I realized that there's a lot to learn, and I started doing bigger deals and bigger deals. And then, of course, I blew right past that goal. And then we just started some strategy around building a company. And right now I have about 300 people in my firm. And, we do
Wow.
construction, development, property management. Basically are our three main core businesses. And we do that basically in the Western US mostly. So right now we're pretty heavy in Texas, Arizona, but it just started with that one. And I wasn't really too scared to buy it like a lot of people are. And the reason is because I was in the property management business. It was really my only job right out of school. So I did understand what it takes, what kind of renters to get, how the numbers worked, because I was already in the business. And so I started seeing I was in the fee management business, which means that you take on other people's assets and you manage it for them. And if you don't do a good job, you get fired, so that was the motivation, was not to get fired. And so you really had to get good at that. And so by the time I actually had the courage to do it myself, I wasn't freaking out. I really felt like it was a better alternative than, just putting my money with a wealth manager and then trying to understand how it was invested. Because even a lot of times they didn't know it. The irony is right after I got out of school, I remember my buddy said, "Hey, here, you got to throw some money with this guy and the wealth management business." And I did. And about a year later, I looked at it. It's like barely, moved, basically hardly at all. And then a year later, it barely moved at all. All of a sudden, each year it barely moved. I was like, okay, well, that's not really working. So that's when I kind of poured myself into the real estate.
And then, so from those single family homes, you're doing property management, so you kind of learned the game. What was it that took you to that kind of next level, and what skills did you need to take that next move up?
So yeah, so what happened was my first business was a property management business. I said, this is going to be a great way for me to support myself. So I was out hustling new clients and trying to get new business, new property management clients. And of course, the property management business, you're going to get like maybe 50, 100, $150 a month on the management side for a single family house. On a 100 to 200 unit apartment project, you're talking about 3-4 grand. So obviously it doesn't take a rocket science to figure out that the bigger assets are going to pay more management fees. So That's what I started focusing on. I started focusing on the bigger assets and building a team under me. So once I started to do that, I started realizing that these partnerships that were owning those, they were just normal people. They were, doctors, lawyers, business people. They were trying to bypass Wall Street as well. Maybe not completely, but they were just trying to keep their money in different spots. And that gave me the courage of jumping out into the bigger assets, but only after I had kind of seen it from the inside out, because as a property manager, you pay the mortgages, you pay the expenses, you run them, and you do all the things that the investment group wants. So so once I figured out, okay, good locations, value adds, and try to figure out how to raise capital on that. So I didn't know how to do any of this. I didn't know how to get a loan, didn't know how to raise equity, didn't know any of that, but I did understand the fundamentals of the operations.
That's interesting, actually. That's almost like a hack on how to get into bigger projects because to your point, if you're managing those units as a property manager or under a property management company, like what a great way to learn everything that you need to learn outside of maybe the money raising piece and the how to set it up on the back end. But yeah, I love that.
Well, the best part is the very first big project that I bought was 182 units. And it was from a client that I was managing for already. So you imagine, okay, I had the relationship with them. They were out of New York. And the grandson would fly out to Arizona every once in a while. And this was a bigger project. By the way, I still own it. So the thing's probably worth 45 million today, and I bought it for nine and a half, I think. Basically on a handshake almost, and so that was the first big break. I didn't have to go out to the market, and compete with a lot of other people. I actually did it with a client I already had. Because they wanted to move their money somewhere else. And so the timing worked. And I said, would you give me the opportunity? And then that's when the rubber hits the road, man. You got to learn how to raise the capital. Gosh, I was probably in my early 30s during that time. We still owned the building. And it was brand new at the time.
Wow. So you kind of got the connection because you were managing the building. And he said, hey, I'm thinking about selling. And then you were thinking about maybe I should take this one down as a first one.
Yeah, so this happens a lot in fee management. If I at the time I think I was managing 4,000 or 5,000 units or something, so maybe I don't know 20 properties or something, 30 properties, and so they call and they say, hey, we're thinking about selling the building, and the property manager is very involved in the sale because one, you were trying to keep the net operating income the best it can be so it presents well. Also, when there's buyers coming through or whoever it might be, has to show the best. And so, there's also a little disruption, obviously, with the normal operation. So the property manager is typically an integral part of a sale. And so when they came to me, I was like, well, would you sell it to me? And I had an incredible relationship with this owner. And I'll never forget it. I was walking through the airport, and he called me. He's on the Forbes list, one of the wealthiest people. And he said, he goes, yeah, we would do that. He was at the time, I think he was in his late 80s, and he just gave me the greatest gift and said, yep, I believe you can do it. And gave me that first opportunity. But I will tell you, it's because of the relationship and the trust I had built up to that point. So I was communicating to him when I took the property over, it was not performing well. And I turned it around. And I communicated to him all the things that were wrong, but I had solutions. And so we had this good, nice year and a half, almost 2-year relationship on the management side before they decided. And obviously, as I turned it around and got it full and all that stuff, that's when they decided to sell it. And that's the best time to sell a property. So for me, it was just, say, I think I could do this. And that was it.
Yeah. Yeah, that's another thing that always comes up is as well, the best deals you always get through relationships, right? Like it's you had a relationship with this person, you were already managing the unit, they decided they were ready to sell. You know, you're an easy person to take it over because you're already familiar with it. You already know the ins and outs. Um, Given the fact that it wasn't performing that great, what gave you the confidence to move in there and want to take it over? And, you know,
So
how did you raise the money for that, or did you fund it yourself?
no, gosh, no, I didn't have a nickel, man. I was, all my deals were in those single families, all my cash. But I was, again, I had my own company at the time. It was called McElroy Management, and I was running. I think I had an accountant and a receptionist, and I was, uh, you know, I was running it as tight as I could. As basically, I didn't really have a business at the time. I thought I did. It was really a busyness. I was busy, man. Just trying to grow new clients and all that. And so what I saw at this particular property were there was a couple real specific things. And by the way, the only way to do this is if you're in the game, And so they had some vacancy issues on the second floor of the property, so that was one that I saw. Two, I was like, okay, why? And two, they had some expense issues. They were running some stuff out of New York. And also they had some expensive contractors. So what I did is I brought my contractors in, lowered some on the expense side. I brought a different management team in, but the biggest thing that really turned the needle for them was that they had not priced the property correctly. So when you buy a property, there should be different units have different premiums. So like a view unit, you would imagine, would be a little bit better than a non-view unit, as an example, or an upstairs
Mhm.
unit might be, in some cases, less than something on the ground floor. Not always. Retirement community. So it's in Sun City, Arizona, and the seniors, the 55 and older, they didn't really like the upstairs.
They like to
So
be on the first floor.
yeah, yeah. So the first floors were full, and the upstairs, were largely vacant. So what you do is you don't discount. What you do is you raise the price of the units on the first floor, and then
Mhm.
now there's a difference, and that it starts to fill up the second floor. But again, this is some of what you learn, as you're grinding through the property management world. So all of those things had a big impact, on the operations. And in addition to that, they had a pretty big construction issue from their contractor. In other words, they had a lot of problems because it was a new property. And I was able to clean that up too. So, there were some construction defect issues and things like that, with the stucco and the roofs and all these things. So I was solving all these issues for them in New York,
Mm.
but that's actually what a good property manager should do and does do. So they were completely grateful, obviously, and it was the farthest thing from my mind to buy it. But all I was trying to do was keep the business, And when you have a full property and you're sending money to the owner, you don't get calls, So
Yeah.
the minute your vacancy comes down and all of a sudden there's no money to distribute to the investors, let's say they're limited partners, you get a lot of calls, you get a lot of attention. So the key to that world is manage it well, keep it clean, and keep the occupancy high. And if you do those things, you'll keep the business.
Mm. I love that. That's great advice. And so I'm curious, how did you put that deal together? Since you said, you didn't have two nickels to rub together, and that seems like a big project. We're not talking about, an eightplex. We're talking about over 150 units. So that's a big swing.
Yeah. So really, what I did was, luckily, they didn't list it, which was huge. That's number one. So I didn't really have the pressure.
Mhm.
And I started going out just like you would to find out, okay, who do I go to for a loan? Who do I go through for the debt? And then I would contact, maybe the two or three people on that list. I would meet with them, and then I would find out, a lot of times they educate you. They say, this is what we can do. This is how much the loan could be. And then you kind of solve to the equity, which of course I also didn't know how to do. So I started with the debt. And then I started figuring out the equity. But the interesting thing is that people that are working in that, call it the financial world, whether it's debt or equity, a lot of times it's the same. So a lot of times these brokers, they want to sell because they're getting a commission. So they helped me largely on the equity side too. So we put together a business plan and said, I think at the time I needed about 3 million. And it's the first time I had raised anything like that. And we put it out, and it took a while, lots of phone calls. And back then it's just, knocking on doors and meet with people. Just that's exactly how I met Robert Kiyosaki, not on this deal, but much later. Is, really old school. Now it's so much different because you have the internet and you can blast it out, and there's all these forums of Facebook and LinkedIn and all these things. But then that didn't exist. So you literally had to find those influential circles. Because I was in the property management world, I also knew a lot of limited partners in my other deals. And you start to scratch the surface, and you start to meet brokers, and you start to meet investors, and you start to meet those kinds of things. You start to build your circle of influence around that space. So it wasn't easy, but I would also say it wasn't entirely difficult because the property cash flowed really, really well. So the terms I was getting, or I got, I should say, were good. So the investors, they'll always say, well, they'll invest, but they only invest in like a real deal. So it happens a lot of times. People go out, and I thought this is what I needed too. I thought, I need a big war chest, or I need all these people to commit to money before I go out and have the courage to go find something. Well, I didn't have this. I realized it's quite the opposite. What happens is, if you have something that cash flows and something that's proven, because I remember I was a property manager, so I understood the numbers. And so I was able to sit down with the investor and say, hey, I manage this building, and these are the financials. This is how it is. So I was raising money because now you got the investor has multiple choices. They have stocks, they have treasuries, they have gold, silver, they have all those kinds of things, plus all these other kinds of investments. And they're always trying to solve to a return of some sort. So as long as I was, meeting that or better, then, they would invest. And that's what I always tell people that are trying to figure out how to raise money, is that the deal actually raises money. Let's say I just put 10 deals together. Every single deal has a different return, different market, different rents, different expenses, different debt, different whatever, different age, So in this particular one, it had a really nice return. And, it did take me a couple months. It's not like blasting it out on the internet like you could do today, but we ended up putting it together, and then you just mirror the equity and the debt together, and then, hope that you close. So that was our first.
Yeah, that's good. A lot of interesting takeaways there. I fully agree. The deal makes it way easier to raise the money.
Yeah.
If you've got the deal, the money's not hard to find. Asterisks, as long as it's a good deal.
Yep.
Yeah. And then the other thing there, I think having it be off market, so you're not competing with a bunch of other people. You're direct with the seller. I think that probably gave you the time you needed to kind of set up all the ducks in a row to make it happen.
Yeah, so that was a really interesting point. I didn't realize at the time, obviously, because I was managing the building. But then brokers were calling me and like, how'd you get this deal? Because, once it records, it closes, you own it. Now I got on everybody's radar. Okay, this guy's putting deals together. all of a sudden I started getting on everybody's list. This could be it. And then, those doors do open, whether you want them or not, because it's public information. But
Yeah.
you're spot on, where I didn't have the pressure, and I didn't feel the pressure of competing against multiple buyers and having no experience.
Yeah, one thing I also thought interesting, and I'd be curious your thoughts on this, is that you still own that property today. And I think that's maybe a little bit counter to the school of thought that once you kind of max it out and you've turned all the units, you've renovated the place, that's kind of when it hits the top dollar mark. And that's when a lot of people would think about, like, let me exit and then let me go repeat. How did you look at holding it for a long period of time versus kind of selling once you've done all the renovations and got the rent rolls up and all that versus keeping it?
So this really boils down to a philosophy for the general partner and the partnership. So you're right. Most people, they are basically, it's one big flip. So I mean, anything and everything has a defined exit. So with us, I was always a cash flow guy. So I always wanted cash flow, and so I knew also Mr. Litwin, who I bought the building from. He had over 10,000 units in Manhattan, and he'd been buying them there for 40, 50 years. And so, having somebody like that to bounce stuff off of and realize that there's a time to exit some and there's a time to hold others. Take advantage of now. What I've learned is the massive tax advantages to owning real estate, because the IRS gives housing providers massive tax incentives and breaks. So they're legal. Obviously, I didn't know this at the time, so I was just trying to generate the passive income. And so what was happening is I was getting all this cash and I wasn't paying tax on it. And I was like, how is this even possible? And they give you what's called depreciation. So they depreciate the building. For multifamily, it's 27 and a half years. So, so we were getting cash, but paying no tax. And I was like, man, this is really, really incredible. And that's actually what drives a lot of investors. Is a lot of times investors, especially my high net worth investors, we have about 6,000 of them now. And, they're doctors, they're athletes, they're lawyers, they're business owners, and they're crypto or whatever it might be. They're making a lot of money somewhere and they're paying a lot of tax and they're frustrated. And so they're looking for things like this. And so once I realized that, I was like, oh man, like this is a great strategy. And so that's actually how I started to my first goal was just to buy 1,000 units, and then my next goal was to buy 5,000 units, and then my next goal was to buy 10,000 units. Just haphazardly, just putting goals out in front of myself. Then I had to learn how to build a business, of course, to run it all. But that's essentially how I did it, all completely organic.
Yeah, no, I love that. And I did actually have a question here as well about the tax stuff because I do think that's important. How do you kind of structure your deals to maximize the tax advantages and the returns?
It's a great question. So there's basically a few things that we always try to do. Number one, we always try to buy deals where there's what we call forced equity. So that's some kind of a value add. So think of buying a vacant building and before you close, having a tenant in it. That's a value add. So there's hundreds and hundreds of strategies to buying a multifamily deal and creating value add. So that could be through, like I said, the premiums. It could be through upgrading the property. It could be from adding things or adding units. We bought plenty of properties where we built second phases, and there's a zillion things that you can do. So that's number one. because that's what we call the story. That, the property has a story. So we're buying it for 10 million, and when we're done, it's going to be worth 15 based on this story. So that's the first thing. The second thing is the loans, as let's say on that exact same property, let's say it's a $10 million property and there's a $7 million loan, 70% loan to value, let's say. The tenants are paying that down. So if you're full, the tenants are actually paying down the mortgage for you. So you get that. You get principal pay down from the actual tenants. So that's the second thing. The third thing, of course, are the tax pieces. So there's a couple that I'll mention today. One is just straight up depreciation. So on that particular property, a $10 million property, what you do is you back out the land, because they don't let you depreciate land. And then you divide, let's say land's $1 million, and you take the 9 million, you divide that by 27.5 years. That's your annual depreciation expense. It's called a non-operational expense. So, let's say you got 200 grand of cash flow coming out of that property. You might have 300 grand of depreciation. And then you show, actually the partnership shows a negative $100,000 loss. So you get the 200, you get the 300 depreciation, and you get $100,000 loss as reported to the partnership. That's how depreciation works. And then if you're doing some kind of a big rehab on it, you can actually capitalize that. That's called, I think it's called bonus depreciation. So if you put like a new roof on and new parking lots and paint it, you can actually write that off on a different schedule even quicker. So I started to realize all these things, and you start to now, it's just like a recipe, each one. And the goal is to provide cash flow and then not pay tax. And the best thing is, let's say I'm able to do that. Let's say I'm able to take something from 10 million to 15. Then when that's all done, and I've done the work on the inside, and I've raised the rents, and I've tweaked the net operating income and all that, then I go back to the bank and I say, hey, like this property is now worth 15. They do an appraisal. Then we go out and get a new loan, let's say for 10. So the thing's worth 15. Now I get a loan for 10. So that 10 pays back the original 7 million in debt. Plus, it also pays back the equity. So now at that point, that's why I wore this. That's why now you're infinite. You're literally infinite. The investors are still in the deal. They've gotten 100% of their money back. The property and what I spotted and what I saw, I created the value, created the wealth, gave everyone their money back. Now, at that point, it's not necessarily a return, because I'm just literally, I use their money for a few years and I give it back to them. So it's not a return, but they're infinite now in the deal. They actually have no investment. And then the property still continues to produce cash flow, you get the tax benefits still. And I have still 5 million in equity. So on the property that I first bought, I've done that 3 times. So, so what happens is, as rents grow, so do expenses. Rents grow. You just continue to, obviously I bought that thing over 20 years ago. So I think I've had at least 2 or 3 value adds on it, right? Like, it gets dated after a while, just like a house. So, new appliances, new flooring, new this, new that. And then you're slowly, as your property slowly, doesn't keep up with the new stuff, you start to see these gaps. And then what you do is it's just constant adjustments, and you just keep bringing it back. The technical term that we use is the second and third bite of the apple. You know what I mean? But you just keep the asset, and then you just keep harvesting the cash out of it. So you can imagine those first people that invested in my first $3 million. I don't even know how much they've gotten back. I would say
they love you.
Maybe 15, $20 million on that or something, plus the reoccurring cash flow. they're still my partners.
Right. So they get to stay in the deal. The rents continue to go up over time, like you said. They tenants continue to pay principal down over time, and so you can keep refinancing and get pops of cash, and keep renovating to get that second and third bite of the apple, like you were talking about.
Yeah, that's the model. And so that's what I learned from Mr. Litwin. So that's what a lot of people don't do is if I would have sold that property, let's say for 15, after that 3 years, I would have had to pay the depreciation recapture. I would have had to pay capital gains. I would have lost that reoccurring income. And I would have made a bunch of money, of course, but then guess what? I would have had to reinvest it again. So
Right.
what I would rather do is give that 3 million back, pay off the 7, and then those investors use that money again. So those investors, of course, invested in my second deal and the third, so that's how you build investor trust. That's how you build momentum but it has to start with that deal that makes everyone money, because people forget that the real estate, it actually pays everybody. So you have to spot it, and then you have to know how to do it. And so that's where that property management background, became my, kryptonite, I guess, or not kryptonite, maybe it's not the best, but, it became my power is I could see the deal, and I could actually see it. I could see, okay, I could take this and bring it here. All I got to do is bring in this money. And so I started syndicating, 20 years ago, before it was a thing. And, we just keep everything we can. That's why we own, I think we own about 2 billion now, but I think that we're not even $1 billion on the debt side. So we're maybe 50% leveraged so we have like $1 billion in equity on the stuff that we own.
Yeah, that's amazing. Yeah, I love that. I was curious to see what you were going to say about that. So shifting gears a little bit, there's obviously challenges in the market right now. How are you sort of adapting your business to the new market, and what advice would you give to everyone on that?
So yeah, I think this is a tale of two cities. So what I mean by that is I think single family is reacting and doing something very differently than commercial. So I want to make that clear, because a lot of people lump real estate into one category.
Very true.
Yeah, so it's very different right now. So what I mean by that is I think, well, first of all, we're severely undersupplied on single family in the US. So it might be different in some markets. Some markets have people leaving, some markets have people coming. So, single family real estate is very, very different and acts very different in all those individual markets. It's like San Diego is very different than Phoenix, and which is very different than LA. And so so you have to know that going in. I'm still very bullish on single family long term, but at the moment, commercial's getting hammered. So commercial's getting hammered because the values of commercial real estate is based on a cap rate or capitalization rate. And as interest rates move up, then cap rates move up and property prices come down. So just said another way, let's say I bought a 200 unit building a year ago, and the rate might have been 3%. Well, that same property, same rents, same expenses, today is 6%. So the mortgage payment is significantly different than a year ago. So as a buyer, I'm not going to pay the same price because my cash flow is obviously going to be a lot less. Mm-hmm. So the mortgage payment at 6% is a lot more. Therefore, the cash flow is a lot less. So what's happening is there's a big disconnect between buyers and sellers. So the buyers are saying, listen, we can't pay what you want because these rates have eroded any cash flow that you might have had a year ago, but these rates are so high. So we're seeing a lot of cracks on the commercial side. And so let me walk down that. So you've got office buildings that are really in trouble.
Yeah.
You've got retail that is competing against Amazon, the bricks and mortar. A lot of people are just going to those places to shop anymore, with the exception of grocery stores. Um, self-storage is still doing well. Multifamily, it depends on when you bought it, and when your exit is. Hotels are a little bit in trouble. Industrial is really, really, really strong.
Yeah.
That last mile distribution. So again, even commercial is not, all the same. So it's going to be interesting to watch the Fed and what they do with interest rates this year. I still think that they're going to go up because they have an inflation problem that affects everyone. And also, let's don't forget, housing is inflationary. They look at housing and autos as inflationary. And so they're okay with, in fact, I think housing was somewhere about 40% of the CPI. So they want housing to be tempered. And the reason that housing's in a bubble is because of the low rates. So this is just part of the process. I'm not at all concerned. It's a great time to dial in your operations, to get all those things in order. That's what we're doing. We're making sure that our processes and systems are dialed in. We got rid of a bunch of softwares and consolidated. We're taking a look at all our expenses, utilities, insurance, property taxes, and all that kind of stuff. Not that we weren't doing that, but it's really, now that we're not really actively buying, even though we're trying every week, we make offers. So I have a whole investment committee and analysts and everybody who work for me. We're out looking, but there's still just a little bit of a difference between what the seller is willing to do and the buyer is willing to do.
Yeah, that's very interesting. I think we're obviously seeing the same thing here. We're mainly in the residential market. But a quote I heard you say the other day on some interview I listened to, I don't remember which one it was, but you said, and I thought it was perfectly accurate. You said the buyers are looking out the windshield of the car and the sellers are looking in the rearview mirror of the car, because the sellers still want the price that they could have got, a year ago, and the buyers are like, well, wait a minute, like it's not the same market, interest rates are different, everything's different, and we want to be on that price over there. And that's kind of the disconnect that you've been talking about.
Yeah, and if you're a seller, it's frustrating, because we own a lot of property too. So everything that we own has also gone down in value, but the difference
Yeah.
is that we're not trying to sell it. That's
Yeah.
the difference, and if rates go back down, then those values come back up. So it's really a timing issue for a lot of people. And if you are in a position where you have to sell, then you're going to be in a bit of trouble, and why would somebody have to sell? Well, their loan matures, or they're on some kind of bridge, deal where that expires, or their equity wants their money, and there's a defined period based on that. There are reasons that people have to sell, and if they got any kind of a floating rate, let's say, a year ago, their mortgage payment is a lot different today than it was, let's say, a year ago on the exact same asset. So the irony is these properties are, in many cases, are producing at or what they said they were going to, and the difference is that debt. So
Yeah.
yep. So that's the issue.
So that being said, how should buyers be looking at the market right now, or how should, we as agents and brokers be talking to agents or to buyers about the market and the forward-looking outlook?
Well, a couple things. One, I'm a massive, massive advocate of real estate on the hedging of inflation. So, if you're doing any kind of investment real estate, well, first of all, on a personal home, my philosophy is I want to be where I want to be. Period. I'm not trying to time the markets. Like if I want to be in San Diego with a view of the ocean, I'm going to go do that. You know what I mean? So
Right.
I think that's one way, for me, that's just personally the way I am. Obviously I want to try to get the best deal and the best rate and all that kind of stuff. But from a personal standpoint, that's where I want to. On an investment standpoint, I think the smart thing to do is keep, if they have a loan that is, say, 3%, which is the majority of people, I think that's an asset. Right now, today's market, you have a loan that's priced less than inflation, it's an asset. So you're basically borrowing somebody else's money at less than inflation. You'd be crazy to give that up. So
Yeah.
the way to do it would be to just make sure that you're cash flowing. So the days of the capital gain strategy of you buy something for $1 million and it goes up to 1.5, I don't think that I would be comfortable in the next year or two in that. But obviously we all want that. So you just make sure it cash flows today. So make sure that your renter or you can cover it with your income. And then, Airbnb or whatever strategy you have, it doesn't really matter. But I'm a huge believer that you should be hedging yourself on the debt side based on the way inflation's going. Because just if you just calculate the last year, I don't know, we were at 9 last June and now we're at 5, I guess. So, call it 6 or 7. If that continues, which I think it's probably going to be, higher than 2, which is their target. You got to imagine that over 10 years that you're going to have 30, 40, maybe even 50% difference in the price of that debt. So the debt is going to be paid off with cheaper dollars later. So I think it's the greatest way to hedge inflation if you can get that fixed rate debt today. And so that's why I'm a huge advocate of real estate investing.
I love that. That's a great point. And on that, kind of like log jam that we're in right now, where, to your point, sellers, they're sitting on these great loans that they got, 2-3% long-term debt on. And so, they're really reluctant to sell, because if they sell, they're going to basically go buy a house at a significantly higher rate, which is causing the inventory problem to stack up, along with the supply issues that you've already mentioned. Like, what in your mind unclogs that logjam?
So that's a tough one, because I believe that they should stay in those assets. So the education that I would say is, listen, you should, you got to figure out another way to cover this. So most of those people look at the equity in their home, and that's actually what they're chasing. And they can do that through other means. Obviously, they can tap into that equity, but I think that asset in that debt is is very, very important. Most people, like in auto sales, they're solving to their monthly payment. So, as you know, so you could have $1 million home with a 3% debt on it, let's say. Well, if they're going to go to $1 million home with 6 or 5 or 5.5 or whatever, it's significant. What they're actually going to probably have to do is downgrade to a smaller house or something that's less expensive, perhaps. So that's not a good strategy for the client. So I think that the way to do it is to continue to push areas and markets that are trending the right way. And if it cash flows today at, let's say, 5.5, they've hedged the upside. But now they're going to, if rates go down, they're going to be able to, they're going to be able to refinance their money back out and get that lower rate at some point. So if they can make sense of with the rates today, which, by the way, as you know, this is about the average of what rates have been in the last 10 years. So people are freaking out, or maybe 20. 5, 6, 7% rates is for how my whole career was based. And so what we just got through, these 3%ers, was a gift.
Yeah. Yeah, I would agree with that. That's something we talk to our agents about a lot is that, the rates where they are now, it's not, when I got started in the business, it was '05, '06, and we were selling 6, 7% loans all day, and we were even selling 125% loan to value second mortgages and like crazy stuff like that, which obviously good thing that stuff doesn't exist anymore. But to your point, these rates today are very normal if you look back over the last 20 years.
Correct. Yeah, and the difference is the prices are more. So that's all.
Yeah.
And
Yeah,
so I
exactly.
do think you're going to have some price adjustment, and also the education's got to be with the actual person, and if they need the equity for their next house, then of course that's a different issue. But if they don't, or they can tap into that for their next house, you kill two birds with one stone. They keep
Yeah.
what I consider to be an asset on that loan. They cover it with an Airbnb or a renter or whatever, and
Yeah.
they scoop their money. And that is how we all started anyway. Maybe they just don't. They're just not real estate investors. So that's what I would do. I would go right after them because, especially in your world, in your area, some of these people have a lot of equity.
hmm Yeah, especially over the last couple of years, the run we've been on. Um, So on that note as well, one thing that I'm seeing a lot of people doing right now, and I think I already know your thoughts on this, but I'm curious. They're buying investment properties at a loss, and their whole theory is like, look, I need to get in. Prices are going, have gone up so much, and they don't see them really coming down at all, even though the interest rates have gone up quite a bit. And they're, buying a single family home or a condo or whatever, and the rent is, let's say, $500 less per month than all of the expenses, and now they're basically losing $500 a month every month on that property. But in their mind, they're thinking, I'm just going to cover this for the short term. Eventually, rates will come down. Eventually, property values will continue to go up, and there'll be a point where I can kind of readjust it to become a cash flow property. But I'm curious what your thoughts are on that.
Well, that's the opposite of passive income. I'm so just to put things in perspective, any deal that we have that's tight on cash flow or has occupancy issues or market issues, those are the ones that we sell. So, the way to do it is to keep, what my buddy says, keep the golden goose, the one that lays the golden eggs. And always, if you are going to sell something, sell the ones like that, because you don't want to be in a position where the money's going into the property each and every month just to pay the mortgage. Just that to me doesn't make any sense at all, financial sense. The whole point of investing is to get income. That you'd be better off putting your money in a 3-month treasury, which is paying somewhere between 4 and 5%, and it's the government. So why would you invest in real estate, and pay 6 grand a year, of your hard-earned money just to a lender at this high interest rate? So uh,
Mhm.
it's really a horrible philosophy.
Okay, I like that. So, what would your advice be to those people? Would it be to like you said, put your money into something that is going to earn a little bit of a return, keep building it up, and then maybe put more money down to be able to get it to cash flow later on? Or would it be to keep looking until you find a deal that does cash flow? Or like, how would you advise that type of a person?
Well, anything for me that loses money, we get out of, period. Or we think is going to lose money. That could be from interest rates going up or big, right now we're seeing big property tax increases and insurance increases and utility increases, or flat rents or concessions or whatever it might be. Anything that adjusts the cash flow, we're way ahead. So we're like, okay, we want to get out of this market. I bought some stuff in Oklahoma City years ago that had a whole bunch of new apartments dumped into the area, and we started having occupancy issues. So I sold it to cut my losses, even though I was cash flowing. So that's the difference. I was still cash flowing, but I'm like, I'm not going to have this long-term cash flow. So number one, I think, yes, get out of that, and because what you want right now is you want to be in equity, you want to be in cash. So we're cash is king right now. So you want to be in a situation where you can be able to act quickly and not have to rely on the debt side. So in fact, as you know, we're seeing pretty serious underwriting changes, since Silicon Valley and Silvergate and some of those other First Republic. Some of those banks, are kind of rattled people. So, I read an article yesterday that there's several banks pulling out of auto financing, as so there's banks that are pulling back right now all over the place. And so you just want to be in a situation where you have lots of cash and you don't want it going out the other way, because if you've got a situation where you have to fund a deal to get out of it, it's even worse, especially if you're negative cash flow and the property's worth less than the debt. You're in big problem. So I think this is the time to get into cash.
And then when would you deploy that cash? What would you need to see to deploy that cash?
So for me, every decision I ever make is based on cash every time. So as an example, I'll look at maybe a dozen deals in a month in Phoenix, let's say, big deals. Every single decision we make, every offer we make is based on, does that thing cash flow? And they're all different. So that's the same thing whether we're in Boise, whether we're in Dallas, Fort Worth, Austin, doesn't matter. It's all based on the actual asset. So we look at the math. I always tell everybody it's just math. So where is this thing going to pencil out? And then so let's say I'm putting 100 grand into something. For me, it's got to produce 5, 6, 7 a year, 5, 6, 7%, 8% cash on cash. So it's 8 grand into 100 grand is 8%. So I'm always looking at the cash on cash, and always. So that's number one. And then if my tenants pay down my debt, then I get that. And then also I get the depreciation as well. So I'm always solved to cash flow every single time.
Love that. Yeah, that makes sense. So just keep looking till you find a better deal, I think is the advice to those people that are thinking about taking a deal that will be upside down and then waiting on rates to refinance at a later time. It would be just,
because
let's find another deal that will cash flow now, and then you can still refinance later, and then you'll just have more cash flow.
if your philosophy is I think going down, you could be in trouble.
Right.
They might be, and I hope they are. We both do. Don't get me wrong, but that should not be your strategy.
Yeah, completely agree. Love that. So a couple questions just to wrap up here. If you were starting over in today's market, what would you be doing? Where would you be looking?
Sure. Yeah. So one of the things that we're doing actually in our firm is we're trying to figure out where everybody went, because there's all kinds of stuff that's happened. You've got the work from home stuff, the pandemic, COVID. You got a bunch of policy and policymakers, disrupting areas. I'm from Seattle, so my friends are moving out of Seattle, and and also I had stuff in Portland, and I know you've got your issues in California and New York and all that stuff. So the point is, where are those people going and why? And they're going for good schools, they're going for good weather, they're going for better policies, maybe places that are less expensive, places they can work from, all that stuff. So that's the first thing. So take a look and see, people vote with their wallet. They go where they want to go. That's number one, because real estate exists and does well only if there are people there. So that's the number one thing. So what
Yeah.
happens is, for example, like one of the markets that we've been buying in is Austin, Texas. Well, there's a lot going on there. There's, all kinds of tech, there's big companies that are
Yeah.
relocating there. So there's a strategy. We just didn't decide to go there one day. There's a whole strategy behind that. And so what you want is you want that, that tsunami of people that are going there. It's going to show up. It'll show up in the restaurants. It'll show up in the schools. It'll show up in the, the mom and pop businesses. It'll show up in the real estate market, both on single family and the rental side, all that stuff. And all you're doing is adding more people to an area with an existing infrastructure. And it's going to put pressure. It's literally just a supply versus demand.
Yeah.
And so that's really the way we invest. We like, where are people going? And you don't want to be a pioneer. You want to make sure this is all thought through. But then what'll happen is the market will save your ass. You still might even buy incorrectly, but if there's too many people coming to an area, and there's hardly any inventory, both on the rental or single family side, you're going to be fine. So that's essentially what California has had for a long, long time. People love San Diego for all those things I mentioned, and that's why it continually is attractive. So you just got to find those spots around the country, and there's a lot of them.
What's a good resource to find information like that for people?
There's a bunch that we use. Oddly enough, well, some of the easier ones that you can Google right now are North American Van Lines, U-Haul, Ryder Trucks. Now, I know that sounds goofy. That, by the way, I'll give you more. But if somebody rents a truck from Seattle to Phoenix one way, like
You know where they're going.
yeah, it's trackable, right? So believe it or not, they produce this stuff. It's very interesting. The other one, of course, or most obvious, are out-of-state driver's licenses, which are also tracked. I mean, when you move somewhere, you're supposed to establish yourself as a resident of that state, for tax purposes and all these other things. So there's a whole bunch of data around where people are going, and all you got to type in is migration patterns of people. And this stuff will come up, and there's different reports showing different things. But right now, it looks to me like the leading states are Florida, Texas, Arizona, the Carolinas, and Tennessee. That's where people are going. 2 years ago, it was Boise, let's say, or Idaho. They were on the map. They're not on the map anymore. But so this does change, and you want to make sure that you just go where people are going, and just do provide the solution for the people that are going there, and I think you'd be happy.
Yeah, I love that outlook. I think that's a very safe way to do it. Obviously, if a market is growing versus declining, that's going to be your biggest indicator of where things are going to be in 5 years. And since real estate's a long game, I feel like that's a great way to look at it.
That's right. Yep. Yeah, that's what we do every single time we pick a new market.
Yeah, I love that. So I have two questions I always like to wrap up with. Number one is, in 60 seconds or less, what is the key to being a great real estate investor?
Well, first of all, understanding what your investor wants. So that's one of the things that I learned, is that there's a lot of wealthy people out there trying to deploy money in different areas, and sometimes they're just not educated. So that's why they turn their money over to their wealth manager or their financial planner. So if you figure that out, I can save you tax, you can pay no tax, I can give you income and no tax, and you start to show them how, you'll have as much money as you want. Then the second thing is, you have to have your team. So, I bought a property in San Antonio 15 years ago, It was 50% vacant. It was 680 units. So how do you do that? How do you pull that off? How do you buy that? How do you rehab that? How do you manage that? How do you produce value in that? So you don't have to have them all near you. You just have to know, put that whole team together. So when we bought that real estate, we were able to bring that to Bank of America, who owned the loan at the time and owned the property, and said, this is the team, this is how we're going to do it. So put your team together, figure out what your investor wants, and create value for them, and it'll be a nice, smooth ride.
Love that. That's great advice. I especially love the part about the avatar and knowing the avatar because, to your point earlier, like even within real estate, even within the niches of real estate, there's even further niches of real estate. Like to your point earlier about going into the commercial side, well, that's really like that's multifamily, that's industrial, that's storage, that's, all these other things. And all of those other things are completely different, like where office is just getting hammered right now. Industrial is, really stronger than ever. So just understanding the avatar, exactly what they're looking for or how you want to invest and getting clear on that and then having the right team to support that vision.
You got it. Awesome.
Love that. Last question is I have two young sons at home, 5 and 7 years old, and I like to ask all of the smart, successful people that I talk to, what would you say to them and the next generation on just what it takes to be successful in life and business?
Well, the first thing I would have them both do is I would have them go watch the video, The Red Paperclip, on YouTube. And
Okay.
what that is it's a young man that started with a red paperclip and bartered his way up to a house. So no money exchanged. Very, very, very educational. Your kids will
Love
get it.
that.
It's a
Yeah.
kid. My kids, I started teaching them entrepreneurship at a young age, basically about that same age. We ended up, they were going up finding golf balls, reselling them back to the golfers. And then what was happening is that they were
Nice.
taking that money, and I made them invest in the next business and the next business. From there, they went into duct tape wallets, and from there they went into a pay music site. And so, by the time they were 10, 12 years old, they actually created a website called Create Your Own Tune. It was specialized music. So you could say, I want to do a song for my wife. So all of it was just teaching, teaching about marketing, teaching about this. And so I remember when they made all this money in golf balls, and by the way, they're making $1,000 a summer each.
Nice.
And, at $1 each, and they get it, like a golf ball's worth $1. Okay, I get that. Like, so anyway, when they got to the next piece, which was duct tape wallets, which they were selling, I think, for $10 each. When we went to Home Depot, and I said, okay, guys, so now this is your investment. How much is your duct tape? How much is the X-Acto knife? How much is this? How much is that? Okay, you spent $50. Okay, so now how many wallets will it take you to get back this investment? Well, they're like, well, 5. I'm like, exactly. So after that, now you're cash positive and you don't have any more investment. You've paid for that, but the first 5 are just trying to get your money back. So a lot of that, and then of course, cash flow game is a big one. If your kids aren't playing cash flow game, they should be. It's a game, so they don't realize that they're learning, finance. It's a great game. I played that with my kids. And so those are some of the ways that we did. And my kids, even today, when they were in college, my son was fixing iPhone screens, for, all of his classmates. He goes, every kid in college has a broken iPhone screen. So he was buying them from wherever and doing those for $50 each or 75 or
Love
whatever.
that.
So, so what happens is they start to realize that they don't need you to make money. And my younger son, I remember he came to me one day and he's like, hey, Dad, I want to buy a knife. He's like 12. I'm like, oh my gosh. He's like, but I figured it out. I found 3 knives. They're $30 each. I got my buddies to buy all 3. I'm going to charge 40, so I get a free knife. So I'm going to get 4 knives, and I already got my 4th one for free. Is that okay? So that's what he came to me with. And I'm like, oh, how do you argue with that? You're like,
Yeah, I love that. That's way
so,
okay.
yeah. So, like, so that's why, but it all started with that red paper clip, which is, trading, barter. If they can learn how to barter, like take things that people want, like as simple as like something like this, and trade it
Yeah.
for something. My sons did that too, where there's no money exchange. It's literally just sales. And so they find stuff of value. And there's some incredible ways to prepare your kids.
I love that. That's really great advice. I'm gonna for sure check out that red paperclip video. Yeah, interestingly enough, we had a couple kids, probably 10, 12 years old, ring the doorbell this past weekend at our house, and I thought this was one of the best hustles I've ever seen. They were going around the whole neighborhood, and they would say, the street address sign on the curb, like
Yeah.
just the generic one that's in every neighborhood. They were like, "Yeah, we noticed, it's a little worn out. Would you like us to repaint it white and put the new numbers on it?" And I'm like, "Okay, how much you guys charge for that?" Yeah, they were hemming and hawing. Oh, $40. I'm like, "All right, I appreciate the hustle. Let's do it." But then as they were doing it, I was just asking them, and they had gotten like almost the whole neighborhood. They were making each $100 a day just going around and repainting people's address signs. And I was like, wow, that's thinking outside of the box. And if you got a good sales pitch and a good attitude, it's an easy way to make money.
There's a lot of lessons there too. Whenever kids do, I'm with you. And I stop at every lemonade stand. I give shit to the kids, like, why would I
Yeah.
buy this? How much is it? I always try to negotiate with them just to mess with them, even though I would probably pay double. But just to kind of test them a little bit. And it's funny, man. Kids are tough. They're good negotiators.
100%.
Yeah.
Yeah. It's good to teach them young. Love that. Well, really appreciate your time today. It's been very insightful. A lot of great nuggets for the audience. For anybody that wants to dive deeper with Ken, he's got an event coming up called Limitless. He's been nice enough to give the audience a discount on that. How do our people find out more about that?
Great, thanks. Yeah. Well, so we do this big event in Phoenix. By the way, this is like these are people that I want to hear. In my journey, there's a few people that I want to understand. So I'm personally concerned about the economy, the dollar, inflation. So we got Kiyosaki, George Gammon, Joseph Wang, who works at the Fed, Chris Martenson, just talking about energy and oil and all that. And we got Chris Voss, who wrote the book Never Split the Difference. We got Dennis Prager, Prager University. We have some big names coming, and so these are people that I want to hear from, and it's at limitlessexpo.com. We sold out last year. We had 1,500 people. We're expecting 2,000. It is in Scottsdale, which is absolutely gorgeous. It is a little hot in June, but it's not. It's a dry heat. It's actually really, really, really nice. And the code is Ken20. Gets you 20% off the tickets, and it's in mid-June. It's a must see. It's not a real estate event. It's really a financial education event. Like where are things going? These are people that are going to tell you what they're doing, and maybe what we could be doing differently moving forward.
Yeah. And back to our point earlier about just being in the right rooms, that is definitely the right room. Lots of big players at Ken's events and lots of great information, lots of great speakers, great networking, the whole deal. So definitely appreciate you giving us that discount. And then also, you guys check out Ken's membership site. He's got a ton of value in there. It's very reasonably priced, and I believe that's just at kenmcelroy.com, correct?
That's right. Just kenmcroy.com, and you guys will find everything you want there. We have a lot of free stuff, and just forms and videos and all that kind of stuff. Kind of talking a lot about what we went over today, but of course, way more detail.
Awesome. Well, again, Ken, really appreciate you being on today. I know the audience is going to get a lot of value out of it. And for everyone on the video or the podcast, thanks for watching. If you like money and you like real estate, make sure you hit that subscribe button, and we'll see you on the next one.